Hello everyone and welcome to a market update. Today is the 14th of January. It's Tuesday. First of all, Happy New Year to all of you. I do hope that you've had a wonderful Christmas and New Year break. I certainly had a nice time having some time off with the family, doing a little bit of traveling. Went down to Hobart in Tasmania. If you haven't been there, and I have no excuse because that was the first time I've been to Hobart and to Tasmania. You must go. It's absolutely gorgeous and reminded me of Queenstown in New Zealand. But of course, this isn't a travel blog. This is about markets. And so let's get into the top three things because a lot has happened since my last market update. The top three things today are Hail to the Chief, and I'm pretty sure most of you probably know the reference to that, which I'll get into. Number two is inflation. Number three, interest rates. So, hail to the chief. In 6 days and counting, we have Mr. and President-elect Donald Trump being inaugurated into the White House, and I think it's going to be a very interesting 4 years coming up. He's already made a lot of, I don't want to say noise, it's probably not quite the respectful term I would use, but he's made a lot of statements, I suppose a better way to put it, about the policy shifts and other things that he wants to do, making a lot of statements on things like tariffs, immigration, defense, Israel-Palestine, all of this stuff. And so I think he's going to hit the ground absolutely running. He's only got 4 years to make a pretty significant impact on the U.S. and the world. And I, for one, think he's going to be fine and will do a good job. The Congress, being fully Republican, isn't going to give him carte blanche because there are certainly plenty of people that don't like him in the Republican Party. And certainly the Democrats loathe him, as far as I can tell. But nevertheless, and I'm going to get into this in a moment, nevertheless, the Trump election has put a tailwind into a number of things, not least of which is what's on your screen right now, which is the slide showing small business confidence. And there's two key things I want to just focus on in this slide, which is the first time Donald Trump won, business confidence shot up and went to an all-time high. And of course, we had 4 pretty good years of economic activity there. Then and interestingly enough, when Biden won, confidence and business confidence plummeted, and it's coming off a pretty low level, only seen previously in around 2008-9 when we had the GFC crisis unfolding. But this recent Trump victory has again seen a big spike in small business confidence. I think this is good, and I think this is going to definitely be putting a tailwind to the economy. Part of that confidence, I think, is the fact that Donald Trump is pro-business. He's pro-cutting taxes. He's pro-America. And yes, I'm in Australia right now. I am an American, and I think that being pro-American is not a bad thing. I'd like us to be pro-Australian when we make policies for Australia. But nevertheless, that's going to, again, not to say it a third time, going to put a tailwind in the economy. One of the slide I just wanted to focus on, and what I'm flicking through here, is the recent Hedgeye quarterly update, and there's a few slides I'm going to hit on, but that that business confidence slide is really important. But here's a slide in relation to markets. This slide is a number of sectors. It's pretty busy. There's a lot going on in it, so you can certainly pause the video here and have a real good look. But this is a number of sectors that all have an ETF, or an exchange traded fund, that trades for them and shows you the performance of those sectors. Sorry, I got a bug flying around me, for the term of the last Trump presidency. And as you can see, things like tech fund, the XLK, the consumer discretionary, financials, healthcare, all had huge performances during that period of time. And I am not anticipating that things are going to be any different this time. They could be, of course, but we do have economic tailwinds coming in where the economy has been improving, and clearly from things like the business confidence, small business confidence improvements, and other areas of the market where Trump, I think, is going to have an impact. I would expect that we will see similar types of performances out of these sectors. The good news is I've positioned us for growth, and I've talked a lot about it in my market update, so I won't revisit too much of that right now. But the general point here is, just whether you like Trump or not, I would evaluate him on what he does, not what he says, not how he behaves, but what he actually does from a policy standpoint. And the last time he was president, as far as I'm aware, he didn't start any new wars. In fact, he got us out of, when I say us, the U.S., out of some conflicts. Didn't start any new ones. Seemed to have Russia sort of managed, and broadly was good for America and all Americans, not just the wealthiest 1, 5, or 10%, but all Americans. And I really do hope that that is what happens this time. Enough about politics and Trump. Let's talk about inflation. This is where we really have a serious issue unfolding, I think. I've talked a lot about inflation and certainly its ravages, but inflation has reaccelerated. And this chart is of real-time data. It is not a projection. It is a chart as to what has happened. You can see here that inflation, this is U.S. inflation, monthly inflation figures, troughed in September of last year, and it has reaccelerated to the upside. And I've been talking about this now for the last few market updates at least. And the issue now is the Fed has been sort of kowtowing to Wall Street and other market participants in this continued talk about cutting interest rates and cutting interest rates into 2025. I don't think the Fed's going to be able to cut rates anymore at all. I also don't think the Australian Central Bank is going to be able to cut interest rates, and I'm going to talk about that in a moment. But inflation has reaccelerated in the U.S. It's reaccelerating in Australia, and right now the base case is for continued acceleration of inflation. We're seeing inflation in sorry, I should say the key additive things to inflation are shelter. Does this sound familiar? We have a shelter issue in Australia. Rents are rising. I've got a 24-year-old who we're trying to get to move out of the house. He's out there looking at apartments, was doing so over the Christmas holidays. There's 20, 30 people showing up to an open house for a 2-bedroom unit, around the northern beaches. So it is difficult out there. There's not enough shelter that's being built, so it's putting upward pressure on the price of shelter. Oil has been rising of late. It had a bit of a dip, but it is now back up in the sort of high 70 USD a barrel range. You've probably seen that at the pump recently. We have things like global shipping costs are on the rise, probably because fuel costs are on the rise, but certainly global shipping costs feed into everything. You wouldn't think so, right? Like you would think, oh yeah, shipping costs, they're up, whatever, 10%. I don't know. I'm just making that number up. But to someone who isn't hearing this or isn't trained to think about this stuff, you'd probably go, yeah, okay, no big deal. But it is a big deal, because if you consider that, a lot of stuff gets moved around the world in both ships and planes, the rate of global shipping moving higher is a problem for the goods and things that we buy, a lot of that are imported into this country. And we import a lot of stuff, not least of which is energy. We've seen the energy complex broadly rising. Natural gas is a great example of that. It's appreciated something like 20% in the last month. That's in the US dollar basis. And just broadly, we're seeing the cost of food, fuel, shelter, insurance, you name it, and of course all these wildfires that have been happening in California, billions of dollars of losses. And for any of you who have family or friends in California, I hope that they're safe and that they haven't been impacted by these fires. But nevertheless, that's going to be massive losses to insurance companies to the tune of billions of dollars, and that's going to have an inflationary impact. Certainly, people sort of sometimes argue that it's good for the economy because all those things that were destroyed have to be rebuilt, but all those materials are going to get used to rebuild houses that were otherwise perfectly good and standing, say, a month ago, and maybe those resources would have been able to be shipped to Australia or somewhere else around the world to build housing, now have to go to places like California, or will go to places like California to rebuild housing there. So inflation is sticky, and it's hanging around, and it's reaccelerating. And my point about all of this is to say that it's going to pose continued problems for monetary policy insofar as they will not be able to cut interest rates. So if you are in the camp of you're hoping for or believing any of these economists at the moment who are predicting that the RBA is going to cut rates, I would say not so fast, because here's what will happen to our currency if they do that. So right now the Aussie dollar, and by the way, and I say it all the time, and I hope you're getting the gist of this, which is that we import a lot of inflation. When our currency weakens against the dollar or the euro or the yen, but specifically the dollar, because 90% of global trade is settled in the dollar, when the Aussie dollar goes down against the US dollar, things are more expensive to us. Inflation, therefore, is imported to Australia. And I want a strong Aussie dollar. I want our economy to be ripping, and I want a strong Aussie dollar because, frankly, when I go overseas, I want to be able to buy more with my Aussie dollars, because that's what I earn a living in, and all of you similarly. You want your dollar to go further. And so at the moment, we've seen the Aussie dollar back in September of last year. Interestingly, that coincides with the low of inflation. Around the 70-cent mark. It is now around the 61.5, 62-cent mark. That's a pretty significant drop. That's over a 10% decline in the dollar, or roughly a 10% decline in the dollar. That's going to equate to at least a 10% increase in the costs of the things that we're importing. And with all those other pressures that I just mentioned, who knows, could be even more. So inflation is a serious problem and will continue to be managed by the central banks. And again, I wouldn't be surprised if we see no rate cuts in both the U.S. and in Australia for some time. If we do possibly see a rate cut, like if the RBA was, and I'll say it, dumb enough to put through an interest rate cut at this point, it would probably juice up inflation in Australia, and they'd either have to roll back that cut immediately or simply say that's it, no more rate cuts. What it would do to the currency, who knows? I mean, I would hate to see our currency drop into the 50 to 60 cent range. That would just be a disaster. And it actually reminds me of when I originally came out to Australia, I think around the early 2000s, when the currency dropped significantly. But I think we had like a recession in Australia around that time. I'd have to go back and look that up. But in any case, it was great because I had a pile of money in the U.S. that I was happy to bring out here, but I don't have that pile anymore. So, the currency devaluing doesn't help me. In other words, I want a strong Aussie dollar. Let's make Australia great again. Said tongue-in-cheek, of course, please. Finally, rates. So what's driving interest rates at the moment? And what is it that would give the Fed and even the Aussie Central Bank, the Reserve Bank, a reason to pause? Well, one of the key things, couple key things in the U.S. First of all, unemployment is down. Jobless claims are down. So in other words, the labor market is actually strengthening. Job vacancies and open positions are increasing, which means there's more jobs than there are people to fill them. What do you think that's going to do to wages? It's going to drive them up, right? So employers are going to have to pay more to attract employees. That's going to have an inflationary effect. So the things that would normally enable the Fed to cut interest rates, for example, higher unemployment claims, low job vacancies, unemployment just being higher in general, things of that nature are not present in the market. So again, I say to you, it's highly unlikely that we're going to see any sort of future cuts in interest rates. Now, to that end, and I might just pause for one moment here and make a suggestion. We are at the moment, and I've actually just done this myself. So I've just come off in my home loan a 3-year fixed rate, which was great. And for those of you who 3 years ago, seems like only yesterday, took our advice to lock in around that. I think I had locked in about a 5.25%, I believe, interest rate. Worked out really well. I've just refixed for 2 years with my lender, which is Macquarie Bank, for 5.69, I think. So that would tell you that I think my view on interest rates is, and right now, by the way, for context, the variable rate that most of you would probably be on is around maybe 6.15, 6.2, 6.3, somewhere in there. That's probably where you should be living in terms of a variable interest rate. 569 is, 40 bips, let's call it, 40 basis points, almost a 0.5% below that. And in an environment where I don't think interest rates are going to be cut, and heaven forbid might even go up, then I think that rate is pretty solid for the next 2 years. So anyway, this is a bit of a suggestion that if you haven't had a conversation with Darren about, he's been excellent, by the way, about contacting clients who are coming off fixed rates and asking them what to do. But if you're on a variable rate and it's not somewhere in that 6.1 to 6.3 range that I just mentioned, please do give us a call, and specifically Darren a call, and we can have a look at getting you on that. If you are also on a variable rate and want to look into what fixed rates your bank has available to you, then please let us know that as well. We'd be all too happy to do that. Finally, let's just quickly talk about, again, and reiterate what the next 12 months is going to look like. And I've shown this slide before. It's always good to go back to the data. This is the projected monthly quad outlook in the U.S. for the next sort of 12 months. It's a little bit, I think it's about 10 months to be exact, but it goes through to November of this year. And as you can see, the general mode that we're in is a quad 2 or 3 environment. In that environment, we are looking at inflation being elevated, interest rates staying fairly much where they are. Hopefully, we'll get to a point later in the back half of this year where we will be able to see the Fed cut rates, but I can't imagine that they're going to have a situation where they'll be able to do that. Growth is generally improving, so growth as in GDP. So quad 2s are the quads where we see growth accelerating. Quad 3 is generally where growth is flat or a bit stagnant, but inflation is up, so that's that stagflationary quad. And I'll just show it again, if you have watched anything recently where I've talked about the playbook, I just want to remind you that generally in quad 2s and 3s, this is where we're living in these two columns. And the best equity sectors, best style factors, you may recall I've mentioned this before, and for anyone seeing this for the first time, welcome to the market updates. Please watch them as regularly as you can, because there's usually a lot of really interesting information in them. A lot of repetitiveness, but it's good to repeat and to refresh on what it is we're doing to pull back and continue to have that high level macro view. When we're in quad 2 and quad 3, we want to be living in the secular growth and the growth part of the market, and specifically in the tech part of the market. So tech features in both the quad 2 and quad 3, and quad 1 for that matter. We have one quad 1 potential, I think it was in June or July. And that secular growth, momentum, high beta, those sorts of things are all sort of growthy and a part of the market where we just want to continue to focus our investing efforts. How do we do that? I've mentioned a number of ETFs. I'll just rattle off a couple that you all own in your portfolios right now. VGT, which is the Vanguard Tech ETF, QQQ, which is the Invesco NASDAQ ETF. And those are heavily focused on tech and growth and the growth part of the market. I've just recently made one change where I'm selling down the Russell 2000, the Russell 1000 Growth Fund in favor of the Russell 200 Growth ETF, which focuses and hones even more onto those top 200 sort of growth stocks in the Russell index. And I think I have a chart. Yes. So I have a chart of, this is IWM, this is the Russell 2000, which is a huge, broad, very broad index of the Russell. The Russell broadly as an index, that 2000 is in a bear market, and but the Russell 200 growth will give us that growth exposure, but also cuts out a lot of the really small caps and all that stuff, which doesn't have that that sector style that I'm referring to here, which is the high beta or growth or secular growth characteristic. I hope that makes sense. If not, I'm just going to keep repeating it and talking about it, and hopefully you'll start to catch the drift of these things. If it's not quite making sense, bear with me. It will one day as we continue to talk about this stuff. Finally, last couple things. Volatility has spiked. This is kind of an interesting situation at the moment where volatility has gone in both the VIX, which is the S&P 500 volatility index, the NASDAQ, the VXN volatility index, and the Russell volatility index are all sort of hovering around that 20, and in the case of the VIX, VIXN, which is NASDAQ, and RVX, which is Russell, are nudging just above the 20 level, which kind of puts them in the chop bucket. For those of you who are familiar with the 3 levels of volatility that we look at: investable bucket, chop bucket, and the F bucket or the no-go bucket. We're nowhere near the F bucket, and I hope we don't get there for any particular reason. I think perhaps some of this volatility has to do with people positioning for the Trump inauguration, and just like the election, possibly thinking that, I don't know, something bad's going to happen the day he takes office. Hopefully that volatility, will see it come out of the market in the next 7 to 10 days, and we will then also, of course, have clarity on what Trump's initial out of the gate things that he's doing look like, and then hopefully just get back into everyone being fairly calm, markets just kind of ticking along, and we're going to be having an earnings season kicking off here very soon. So as we start to see companies reporting earnings and then providing forward guidance, that's also going to give us a little bit of insight into whether the market's going to continue on a big run or not. But again, in looking at the slide on the quads, because we're looking at the next 6 to 8 months being quads 2s and 3s, the focus is on the growth part of the market and just really staying pat. We're going to see events like what we've had in the last couple days, a bit of volatility, a bit of sell-off in the market, particularly in the crypto space. It's gotten beat up a little bit, probably because interest rates have moved higher. The bond market is signaling that it doesn't believe inflation is falling, and that typically will and the dollar, of course, has been very strong. That has a correlation to things like your cryptocurrencies, in particular Bitcoin, and to gold, and as such, I think that's why we're seeing that volatility in the crypto space. I did try to find it. I had it open for another client earlier today, and I for some reason couldn't find it and just needed to get this done. But what I was going to show you is we've had a Bitcoin halving in the first of this year, and or no, actually, sorry, when was it? It was about, when was it? April, I think, of last year we had a halving event, and it happens every 4 years. And if you look at a chart of Bitcoin and its halving, what happens is over a longer cycle of about 4 to 5 years, let's say Bitcoin halved it. The last halving, I think, was around the 20-something thousand level, and it went up to 80,000. If you're thinking about getting into cryptocurrencies, you don't have to worry about that, because I've already thought of that, and I have mentioned this in a few market updates. There's a couple of holdings that I've got in accounts, one of which is MSTR, which is MicroStrategy. That company buys and holds Bitcoin on its balance sheet, and as such, we get exposure to Bitcoin by owning that equity. It's a bit more liquid, a bit easier to deal with than trying to set up a cryptocurrency account and owning the coins themselves. And it's sort of my preference, unless you want to own that asset probably for a long term, like 10 to 20 years, in which case I'd suggest you should probably set yourself up with a Bitcoin, Coinbase, or there's a few exchanges around, but get on one of those exchanges and own the coin on an exchange like that. Otherwise, you can just leave it to me, and I will get us exposure to those things, and then get out of that when the time comes. And just on that very quickly, and then I'm going to wrap it up. Bitcoin and pretty much most asset classes do not like Quad 4. Now the question about this Quad 4 that you can now see, as I pointed it out here on your monthly Quad map, in July of this year, it's August with the Quad 1, and then again around November. One of the things about a Quad 4 is it could be what's referred to as a shallow Quad 4, which has the characteristics of even being a little bit Quad 1-like. So as we go through this year, I won't be at the moment too concerned about these two Quad 4s, but as we move closer to these months, in particular probably May and certainly in June, I'll be looking at what's the economic data looking like, what are the what's the direction of that data, has the rate of change changed, is it declining instead of increasing, things of that nature, and then make a call on whether or not I'm concerned about that month being some sort of disastrous month. Unlikely, but look, I reserve the right to change my mind as the data changes and tells us a bit more of the story. So with that, I'm going to say once again, Happy New Year. Welcome back to work and to whatever. Welcome to 2025, and this will be the first of hopefully around 50 market updates for us throughout the year. And please, if you do have any questions about anything, you can always book yourself into my calendar using the book a meeting link in my email footer, or jumping on the website, or sending an email to team, T-E-A-M, at intrepidwealth.com.au. And I will leave it there, and we'll say have a great rest of the week, and more to come next week. See you, everyone. Bye-bye.